Sometimes the best investment you make is the investment you didn't buy. So today we're gonna talk about one of the properties we actually showcased on this channel and how we did our physical and financial due diligence on site and found out some things that made us realize that we shouldn't buy this property at the price we had it at. So we're gonna cover some of those things today and hopefully share some of the things we've learned with you guys so that you can see what you need to look at the properties you are inspecting so you don't buy a bad deal. The worst thing you can do in investing is buy a bad deal, right? You have to actually be very diligent in your due diligence and inspection process so your money is protected. And if you're someone like us, where we partner with other investors to buy large multifamily apartments, we're not just protecting our money, we're protecting millions of dollars of our investors' money. So we're going to talk about all those things that we learned about today. So I welcome back my amazing better half and co-host, Chris Lemire, to this show. If you're new to the channel, my name's Arianne, and Chris and I retired with investment income at the age of 27. Actually, Chris was a little bit older than me. He was 28 at the time. But anyway, we retired at the age of 27 and 28 with investment income through real estate investing, and we made this channel so good people like you can learn how to build true wealth and reach financial freedom as well. So today we're going to talk about the 200 plus unit that we did not buy. So one of the reasons that we didn't buy it, well, let's backtrack a little bit, right? So the last video you saw about it was actually when we were at the property doing our financial and physical due diligence. Chris, you want to do a quick rundown of what that means?
Yeah, so when we're doing the physical due diligence, we're walking through every unit and making sure that we're buying what we thought we were buying. So if they said their units were renovated, we see that they're renovated. If they say they have stainless appliances, we see their stainless appliances, things like that. We also get ages of appliances and that sort of thing on the interiors. And then we check for major CapEx issues. So deferred maintenance like roof issues or major plumbing issues, things like that. Just to make sure that we know we're physically getting the property that we thought we were going to get. And then when we were at the property doing our due diligence, actually the property showed very well. So from a physical standpoint, the property was in really good shape.
It really was. One of the main things that was a red flag even before we went to the property was the occupancy was low. So normally we typically buy properties that are either 90% occupied or more. That's the normal kind of property we like to buy because we like to improve on a property that's already mostly stable. We don't typically buy like 50% vacant properties. We do buy them sometimes, but it's very rare. It has to be a very good deal to do that. But anyway, this property had about an 80% occupancy, which it's not too far from being 90%, but it was still lower than our typical property. And initially, the seller was explaining that the reason that was the case was because there was a flood last year and they were just filling up the units. And so we didn't think too much of it until we got to the property. Once we got to the property, they released the newest financials to us. And that was the first sign that things were not as was explained necessarily when we first got it under contract. So when we got the financials on site, we saw that they were renting out units lower than they were last month. So if a unit was renting for $900 a month last month, this month they were renting it for like $800 a month. So we started thinking, why was that the case? And we went down on this path of interviewing the property managers on site and asking them a lot of questions. And Chris, can you tell us what we found out through that?
Yeah, so they had been leasing the units at a higher rate because they were the first property to come online after a large hurricane had swept through the area and caused a lot of damage, a lot of flood damage. So from our understanding now, they were able to get higher than market rents because they were the only units available, right? People were desperate for a place to live and you'll pay what you can get. And as we started to get these kind of red flags from them, our next step was driving all the comparable properties in the neighborhood to see if our units were actually comparable. And what we found is that there's a huge number of properties that were hurricane damaged, that got a lot of insurance money, and basically rebuilt brand new units. 600 plus brand new units are about to come online in the next 12 months or so. And that is creating a lot of downward pressure on new leases, because now tenants have options. They have a lot of vacancy to choose from, and properties are competing for that wave of tenants.
Right. And one of the things that I want to mention is one of our partners did drive the properties prior to getting this under contract. And sometimes in negotiations in real estate investing, a lot of time pass between when you first do your initial inspections before making the offer and then to actually getting under contract. So when they were driving the units way back then, I think it was October or November. When we went under contract, it was March, right? So almost 5 months to half a year passed by. And back then, there weren't 600 new units coming online. That was an issue, right? But that day after we went under contract, there were. So things can change in a few months, and you have to be willing to actually uncover those things and not turn a blind eye to the things that have changed, because otherwise it wouldn't have been good for us to buy this deal where the income was going this way, right? And with 600 more units coming online, it's going to continue to go this way, because most of those properties are almost brand new properties, whereas ours, even though it was nicely renovated, it wasn't exactly brand new. And there were other things with the property where we couldn't compete. So for example, it wasn't economical for us to add washer and dryer hookups into our units. It would have cost a lot more money.
Based on where the plumbing was that we found during the physical due diligence.
Right, which we didn't know until we actually got in there. Because normally it wouldn't cost too much money to add washer and dry hookups, right? But for the particular layout, once we actually walked the units and tried to find like, hey, where can we add these washer and dry hookups, it just wasn't a very feasible plan.
Mm-hmm.
So that was another issue, right? Like it was going to be hard to compete with these new units that all had washer and dryer hookups, or most of them did, when we feasibly couldn't add them at the price.
There's another thing there too, where when a huge number of units comes online at the same time, this happens a lot in other markets where you see like new construction and someone generates another 200, 400 units in one go. There's a lot of concessions and stuff that go into that first wave of lease up, which is what we thought was happening with this property originally. That's why we thought it was 80% occupied. But when all those other units come online, we're going to get artificially probably below actual market rents for a period of time until all of those units are absorbed. And then we can slowly start working back up to market rent again, which is that could be a long process.
Right. So as we found out those things at the on-site physical and financial due diligence, we decided that it wasn't a good idea to move forward at the price we had it. We're not saying that the property isn't great. We're not saying that the market isn't great, right? Like there is a price for everything. But at the price we had it under contract for, it was with the conditions we saw prior to all of this surfacing and prior to us finding out what we found out at the on-site due diligence, which, you don't have that information until you actually get there. We realized that we needed to buy it at a significantly lower price so that we can actually still meet the returns that we're comfortable with. There is always risk with an investment, so that risk has to be compensated with an appropriate return, and basically we just needed to buy it at a lower price, right? Mm-hmm. There was still a way to move forward. It's just, unfortunately, we weren't able to get to that price where the seller and us were willing to move forward. So we are not moving forward with this property. And with that comes cost, right? Like we spent a significant amount of money, multiple 5 figures, just paying for our property inspection, paying for our hotels, our travels. And so that's...
Attorney's fees.
And attorney's fees. Mm-hmm. So that's part of buying these large multifamily properties. So that was an $18 million apartment complex. And even though it hurts because we took a hit, right? Mm-hmm. Like we lost.
Yep, that comes out of the general partner's pockets.
Right? We lost money on all of those fees, but it's worth it to us because we'd rather take a hit personally and pay out those due diligence costs ahead of time to find out all of these issues than risk millions of our investors' capital on a deal that may or may not work out, right? So it's okay for us to walk away from this deal.
Yeah, much better to walk away from this deal than to lock us in at a bad shake.
Right. So there you have it, guys. Hopefully you learned from some of our lessons on this deal, and hopefully this helps you in your investing journey. Chris, do you have any parting words?
No, just as part of the process, you keep looking at more deals. That cost that harmed us there is part of doing business, so we're going to move forward and buy more properties.
Right. All right, well, we have a whole playlist about multifamily properties and passively investing in real estate if that's something you're interested in. So check that out in the playlist up here. I'll also put that in the description below. But thank you so much for tuning in, guys. We will see you at the next video.